observation is a conflict between what is an economically sensible policy and what is an administrable policy, and I think that runs all the way through this discussion. So it seems to me, in particular with this policy, it seems to be motivated mostly by considerations of administrability, and the analysis of its economic effects to date seems rather thin. So I'm going to at least do some speculation about that, but I think there's a good deal more work that needs to be done. Just to start with the traditional global rules, Gratz went through this history again earlier in much more detail and better than I will. But the general rule that has existed since the 1920s is for cross-border income, the source country gets the first bite at taxing that income, and that applies to both domestic and foreign resident multinationals. And the resident country refrains from double taxation either through exempting foreign income or through a foreign tax credit system. Although there's been a lot of talk about territorial versus worldwide, it's always been the case that all systems have been territorial in the sense that they have always taxed the income within their borders, or tried to tax the income within their borders, of both domestic and foreign-based companies. So that's kind of the starting point. The third pillar of this system is the income determination is based on a separate entity system with arm's length transfer pricing. Formula apportionment, of course, has been discussed as an alternative, but I would view formula apportionment, other than the sales-based part of it, as just simply another way of allocating income among countries, and obviously very different, but at least in that general framework, an alternative way of allocating the source of income. And in practice, there are formula approaches that are used. They're used within the United States to allocate corporate income among states. And in the international transfer pricing world, where there are profit margins allowed under some of the transfer pricing formula, alternative methods to just using the actual transactions prices, they are sort of formula-like in their spirit, even though they're within the rubric of transfer pricing. The traditional approach is really based on administrative concerns, not economics. The source of income is well defined when you have tangible assets, which most assets used to be, or we used to think of most corporate assets as being tangible assets. And the source of income can be defined well for both arm's length and formulary approaches. Again, it's not my position to decide which is best for that in this talk. But the source-based tax never looked attractive on economic grounds. It results first in an inefficient allocation of global capital, too much capital flowing to low-tax countries. The burden of tax, because of this shifting, is shifted to less mobile factors, mainly labor. And of course, we had the famous Harburger analysis where the corporate tax incidence was meant to be on all capital in his 1962 paper. And then when he discovered that capital was mobile 30 years later, he decided all of it or most of it was borne by labor through the shifting of capital. But all of the analyses that general equilibrium models that have that shifting are based on the assumption that the U.S. system, in spite of the residual tax, is largely a source-based system. And of course, this kind of system also leads to competition to reduce tax rates. But of course, the biggest problem with the system approach is it doesn't work. Intangible assets, I've used this analogy, you can think of as a corporate public good. They contribute to output in all locations, but the use in one place doesn't detract from its use somewhere else. And so there really is no good definition of the source of the returns from existing intangible assets. It's totally arbitrary, and since there's no definition, not surprising that it's easy for people to manipulate it. So the paper proposes an alternative. It says, well, we'll continue to use the source-based system for allocating, and I'm summarizing very crudely what's a very detailed discussion, continue to use the source-based system for allocating normal returns to tangible assets where it works, but we'll use a destination-based system to allocate the returns to intangible assets. And again, that's largely on administrative grounds. You really, where sales are or where sales takes place, and that's a very clearly defined system. And that's more clearly defined than either source or corporate residence, and it's inelastic with respect to tax differentials. Higher tax rates are not going to cause people in France to stop buying corporate tax rates to stop buying iPads. So that's a pretty, as opposed to the source definition, which is easy to more elastic, or capital can move more rapidly than sales, easily than sales. So there are really two issues with it. One is the basic premise right. That is this really more administrable, or can the tax base be shifted to low tax destinations? Some of the advocates of destination-based corporate income taxes are extremely dogmatic on this point. Michael is not dogmatic. He's given us a very good and thorough description of ways that the tax base might be shifted. The second question is, assuming it cannot, assuming this works, what are the economic effects of a destination-based profits tax? Who pays this tax? And is this really a desirable tax base? So I'm going to discuss both of those questions, not very thoroughly. So the paper discusses, I have in my notes 3 taxes, the sources of shifting. I guess I didn't read the paper carefully enough. There are a 4th, and I forget which the 4th one is. So, but I'm not running for president, so it doesn't matter. The use of an independent distributor based in low-tax countries. You sell to that distributor. The IP profit goes to that sale. Looks like it's in the low-tax country. And then in the final sale, they just get the thin margin. There may be various ways of writing rules to prevent this from happening, as Michael discusses. The second is sales of capital goods, which are not where the final consumption takes place. And the third is sales of intermediate goods. So all of these can lead to both real and not so real adjustments. And again, when I read the paper, I got the impression that the jury was out on how much you could manipulate this system on all 3 of these counts. And so the question that's left in my mind, is this better or worse than the current system? I don't know. Where a current system, we know the manipulations that's taking place. In this system, we can only imagine the ones that would take place. So that's the difference. So the second issue is, what's the incidence of a destination-based allocation of corporate profits? And I searched fairly unsuccessfully for articles where this is discussed. Maybe someone can enlighten me on some others, but the best papers I could find were 2 that were written 35 years ago by Charles McClure. One about state corporate income taxes, which of course bear a lot of analogy to the worldwide corporate income tax in a global economy. He had the very catchy title of one of the papers, State Corporate Income Taxes, Lambs in Wolves' Clothing. I think I got that right. So what were his main findings? Basically, looking at this and sort of drawing by analogy to the corporate income tax system, we could say, going back to the Harburger closed economy model, the corporate income tax globally, the average level of corporate income taxes globally, is really a closed economy system, because the global system is closed, and therefore the average level of corporate income tax should fall mostly on owners of capital, if you take the traditional analysis. However, the tax differentials, one country's tax rate relative to another has quite a different impact. And in McClure's analysis, where you had a sales-based part of the allocation formula, the tax differentials really fell on consumers in the higher tax states, because basically a corporation selling to a higher tax state would have to recover, based on the sales formula, a higher profit, recover the lost profits from the tax. So you had a sort of two level. The average level is a tax on capital, but for each country, its tax above or below the average is either a tax or a subsidy to consumers. Okay, we've done analyses of the VAT and whether it falls on consumers or labor and old capital, and that's another issue. But it's really basically to saying this is like a VAT, only one difference. It's not a uniform tax on all consumers. It's a tax, a series of differential excises, which fall more on consumers of high tax, of high profit margin goods, or goods with a high amount of intangible profit component. So the question is that a desirable tax base or not? I can leave that to decision. No tax base is perfect, but I think one needs to at least ponder that. Okay, so a couple of other comments on the economic effects. It's not a tariff because the tax rate is invariant with the location of production or the residence of firms. I've come to that conclusion, but I'm not sure what WTO would do. The distributional effects are kind of complicated. Labor and normal profits are taxable at U.S. rates. Intangible profits from exports are exempt. And imports of tangible goods are taxed at the source. So I can imagine a firm, owners of a firm that's in exporting from intangible properties, if most of their output is exported, they might not be paying any tax on that, and that might not be a very desirable distributional outcome. Of course, they will be paying tax on their imported goods, which are subject to this regime. But the imports would be, if the U.S. is a big exporter of intangible capital, this would generally be, I think, a benefit to the recipients of that income, because the U.S. isn't importing that lesser component of intangible. Anyway, that's something that certainly needs a lot more thought. So since I'm out of time, I won't go through this chart, which is a little bit, but I was really trying to compare the tax basis from U.S. activities from these different forms of tax, including the VAT or the kind of tax that will be discussed this afternoon. And as you could see, if you break down the components of corporate profits into wages, normal returns, and supernormal returns, these different alternatives have quite different impacts on how these three components of profits are taxed. The three alternatives being current law, the proposed destination-based income tax, and the destination-based consumption tax. I'm going to stop. I know you have a question, Marty, but yeah.
Imported goods would be taxed on both. How would imports be taxed?
My understandable is that imports, that the U.S. under this destination-based tax will tax the IP profits based on sales to the U.S., so it would be taxing the imports of IP from foreign-based right.
It's a unilateral tax.
Well, but it wouldn't be a discriminatory tax. It wouldn't treat those differently than others, or would it? I don't know, Mike. That you can.
No, I think that's right. And if the US did this on its own, it would be looking for cases where a company has made what we were thinking of as residual profit in the US, and that would depend. And that may be taxing imports from other countries that are sold in the US, net of cost of goods sold and the other elements to calculate the residual profit.
Thank you. I'm going to now read Atai's comments. he was not able to be with us because of a medical issue. And he begins by apologizing for not being able to be here. And then he says his comments were he here would be the following. So pretend he's here. To start, let me set out what I understand to be the key motivations for this proposal, which may be different from those the authors would cite. And he apologizes again. One, the pre-2008 transfer pricing system is dead and unrevivable. Two, the proposed solution, in quotes, set out by the OECD and the BEPS project is entirely unsustainable. And three, the additional layer of capital income taxation that the classical corporate tax represents should be saved, and fixing transfer pricing is necessary to accomplish that goal. I sympathize, he says, with the first two motives and question the third one. The reasons to believe that transfer pricing as it existed pre-BEPS is unstable are obvious for all to see. All one needs to do is read the business section of the major papers. The reason the BEPS project's proposal to fix the system is unstable are less well understood and so worth highlighting. The BEPS project's transfer pricing solution is, in the parlance of the OECD, to align income taxation with value creation. What this means in practice is that the BEPS transfer pricing guidance, taken as a whole, puts great weight for purposes of allocating intangible income and income associated with the contractual allocation of risk on, quote, people functions, and specifically the activity of people who are of sufficiently high skill to create intangibles and to manage the financial risks associated with the employment of those intangibles, and therefore merit the relevant allocation of income. I have come to call this the bourgeoisie labor theory of value. As many of you in the room know, the labor theory of value asserts that its value of a good or service is fully dependent upon the labor used in its production. This theory was an important linchpin in the philosophical ideas of Karl Marx. I don't think the OECD was thinking about that. That was my comment, not at times. In contrast, conventional I'm reading again. In conventional capitalist economic theory relies on a theory of marginalism in which the value of any good or service is thought to be determined by its marginal utility. Moreover, the pricing of a good or service is based on a relationship between that marginal utility and the marginal productivity of all the factors of production required to produce the relevant good or service. In addition to labor, a key factor of production required to produce most goods and services is capital, including real and intangible assets purchased with capital. The BLTV, which I think is bourgeois labor theory of value, effectively attributes value very heavily to the labor of certain highly educated workers, people with education similar to those of the individuals who created the BEPS settlement. The theoretical basis in economics for the BEPS transfer pricing settlement is therefore unclear. It turns the Marxian labor theory of value on its head while being inconsistent with the conventional view too. This makes it even more incoherent than any other basis of transfer pricing, recognizing that all transfer pricing systems are susceptible to the critique that the question, where is income, simply is not a coherent question. That said, in the 2013 to 2015 period, in an environment where respect for contractual risk and other pre-BEPS transfer pricing norms were being rejected, the BLTV seemed to represent an attractive alternative theory of transfer pricing to various government actors participating in the BEPS project, basically because it dealt with the cash box problem of income being parked in places like the Cayman Islands and Bermuda. But the agreement reached in the BEPS project, if implemented in good faith by tax administrations around the world, would effectively provide that a company can save hundreds of millions of dollars by moving 20 or 30 key jobs to a low-tax jurisdiction. And some of those jurisdictions, Switzerland, Ireland, increasingly the UK, are attractive places to live and also have strong, talented, high-skill pools in their own right. That result, that income can be shifted by moving a small number of highly skilled jobs, and that there is a huge incentive to shift those jobs such that individuals can be amply compensated for making the sacrifice, if necessary, is politically unsustainable. Large developed economies with higher tax rates simply will not accept that they're losing both revenue and jobs as a result of the agreements reached in BEPS. And so I would not expect the BEPS transfer pricing settlement to survive for long. Indeed, developments like the UK's diverted profits tax and the similar steps taken in Australia and other jurisdictions, even before the BEPS project were finalized, are signs of early infirmity. Now, he's got something in a bracket in very small type, which I assume gives me permission to skip it, but if not, I apologize. To a tie. Recognizing that the BEPS transfer pricing consensus is likely to dissolve, the residual profit allocation proposal being presented today is intended as a more viable alternative based on the correct observation that the location of consumers is less mobile than the location of key employees. An important question to ask about the proposal is, why are we trying to save the corporate income tax as an income tax anyway? That was a question that we started with. Almost all commentators agree that the corporation income tax is the least efficient tax, that it is distortive of the allocation of capital, and that even if one believes in income taxation generally, the ideal would be to tax all capital income once and only once. Indeed, that is the motivation for all integration proposals as well as other proposals, I take it he's referring to Toder v. Yard, intended to shift the bulk of capital income taxation away from the corporate level and toward the individual level. So there is a question about whether saving the transfer pricing system is necessary if the broader policy goal should be to see the corporate income tax decline as anything other than a withholding tax. Setting aside this broader concern, it is worth highlighting two central features of the residual profit allocation proposal. The first is that it allocates a residual return, that is to say the return after providing an arm's length return to activity to the market country where a product is sold. This differs from both the model and what I will call traditional transfer pricing, where the return is allocated to the jurisdiction of the entity with ownership and risk with respect to an intangible, and the general thrust of the BEPS project, which attempts to allocate the residual return to jurisdiction where key activities take place. The second related feature is that the proposal tends to impose this allocation on a product line by product line and individualized by country by country profit basis, rather than a single allocation for the profits of the entire multinational group. Together, these two features are important in differentiating the profit allocation proposal we're discussing today from both the traditional transfer pricing principles and BEPS transfer pricing on the one hand and formulary apportionment on the other. The product line by product line and individual country profit approach in particular represents a major difference from formulary apportionment, even more so than the arm's length return given to activity. The product line approach in particular makes it possible to talk about the profit allocation proposal as a way to maintain, quote, maintain the arm's length standard. Disaggregating on a product line basis also makes it possible to import some useful administrative principles that have been built up through decades of experience with VATs, and to at least imagine addressing some obvious avoidance strategies that could result. Sales through unrelated distributors and the line between such transactions and sales of intermediate goods, as well as the treatment of intermediate goods sales and the location of consumption of services, represent some of the soft underbelly of the proposal. Workable solutions to these issues would have to be developed for the proposal to be administrable. A separate and interesting question that arises with respect to the residual profit allocation proposal is whether it is consistent with WTO rules. My sense is that WTO's references to the arm's length standard are probably intended to cross-reference the OECD's transfer pricing guidelines and are intended to be ambulatory, such that if the OECD changed the guidelines to reflect the principle of the proposal, it would be consistent with WTO rules as well. However, it is less clear to me whether a country could unilaterally disaggregate the consideration paid for the import of goods and services and then impose a withholding tax on any intangible value without violating WTO rules. So unilateral implementation of the proposal raises some interesting non-tax international economic law questions. At the same time, it is important to contrast the residual profit allocation proposal with the DBCFT being discussed in the next session. The latter faces a significant challenge based on WTO rules. In particular, because the DBCFT is a consumption tax with a deduction for wages, is likely to be challengeable as WTO non-compliant. There may be reasons beyond tax policy to avoid proposals that invite major WTO disputes, given the importance of free trade for growth of the global economy and the level of resistance we see to free trade across the world at the present political moment. That's the ties. Comments? Michael, do you want to say anything in response to either of the comments, or, and then we'll open it for questions.
Briefly.
Briefly.
But, thank you, Eric. Thank you, Itai, for their comments. No, I think I broadly agree with what's been said. I suppose kind of one issue which Itai has just raised is, why are we doing this? Why might we propose this rather than, I think, why I take it doing is something even more fundamental, like the proposal we're talking about this afternoon. And I suppose my personal answer would be, well, for reasons we talked about this morning, it seems likely that corporation tax is going to continue to exist for the foreseeable future, although tax rates are still heading down. And if it's going to continue to exist, then we should think about how we could kind of improve that system in a way which would, remove some of the problems that we have, which everybody has talked about, but without kind of junking it all together. And I think that's how I see this proposal, really. So I don't think we're not claiming this proposal is going to kind of be completely economically efficient. There's, as people have pointed out, there are still issues about how we're going to deal with sales in sales to third parties, which are then kind of moved on to elsewhere, how to deal with intermediate goods and so on. So I accept those as kind of issues that we need to deal with, and we need to come up with reasonable answers to. But I think that's kind of I think in my view that's the kind of what we're trying to do, at least. Why don't I stop there and take other questions? But I accept I pretty much accept the comments that have been made. Let
me just make one other comment before we take a question, and that is that it's emphasizing something that Itai said, but neither the existing transfer pricing system, which lets you contract risks, the pre-BEPS system, or the one that says move 20 people to Switzerland and you can save $200 million in tax, seem stable or designed to solve the problem of where do you tax intangibles. And one thing I just want to emphasize that has not been said is that many intangibles, what we in the tax law refer to as customer-based intangibles, brand names, customer lists, a whole series of customer-based intangibles tend to be properly allocable, I would argue, to the country where the product is sold. And for countries that provide important protections, legal protections, for patents and know-how and so forth, it also seems to me that the country of sale is at least arguably the right country to be taxing this, influenced, I should say, by the fact that the customer is not mobile, which is obviously one of the reasons that we've landed where we have. But if you think about sales of generic pharmaceuticals, for example, where there are no patents protected, you're not going to make the same kind of profit and so forth. So, I mean, that just hadn't been said. It seems to me it's worth saying. Leonard, I think you have a question. You have to identify yourself. I've been told that you must identify yourself, even though, like Eric, everybody knows who you are.
I'm Len Berman, retired basketball player, director of Tax Policy Center. I wish Eric had had time to talk about his table, which compared the destination-based income tax with the current U.S. income tax, corporate income tax, and the VAT. And a couple of questions come up. One is that in the table, Eric pointed out that under the proposal that supernormal returns are mostly exempt, and in comparison under a VAT, the supernormal returns will be taxable, and in contrast, normal returns are exempt under a VAT, and supernormal returns are taxable, normal returns are taxable under the proposal. And that seems like an issue, because if that's actually the way it works, there's one of the big problems is...
I don't think it's right.
Well, actually,
with all due respect to Eric.
Okay.
I don't think that supernormal returns are exempt. That's the residual profits that are being allocated to the sales company.
Right. I think to be fair, because I didn't really get to explain this, there's that last line, additional tax on income, and that's a tax on consumption of intangibles. So there is that
Okay,
piece.
so it is taxed, which would
it
be
is
the
tax
supernormal
on
return.
That would be a piece of the tax. So it's a low rate tax on supernormal returns, because it's only those components.
Well, it may be a high rate tax. It depends on where the country
or a
of
low
sale
ba-
is.
or a low base, whatever.
Well, the base is profit.
Right.
So
Right.
it's a profits tax, but it is a tax. The tax includes rents and supernormal returns. It's not limited to rents and supernormal returns, as I understand it.
Yeah.
Like the destination-based cash flow tax.
So it would actually be nice to just see kind of a decomposition of the tax base and what the tax bases are under these different systems and where they're taxed, and that would be helpful.
Yeah, the routine returns, so the returns to contract manufacturing, for example, are the returns to R&D, which are treated as routine returns, are taxed in the country where those services are performed, distributor returns and so forth. So you're taxing routine returns under this system, which you don't tend to tax, and you're allocating money to countries where they are performing those routine functions, which you don't do under either a VAT or a pure destination-based tax. It's sort of interesting. When we were in Oxford, the NGO panelist said that for developing countries, he really wanted formulary apportionment. And I have to say I was mystified by that comment. It didn't make any sense to me I'm glad to see Vicky's nodding her head no. It doesn't make any sense to me that if you're really looking for protecting developing countries that you'd want formulary apportionment. I don't get it.
I guess I would differ with one thing you said, though. If R&D is expensed, essentially you're not taxing the returns to R&D. What you're taxing is the R&D labor component in R&D.
But you're giving it a routine return. So you're actually giving it a rate of return. So even if it's expensed, you're giving it a rate of return in the transfer pricing context.
Okay. Oh, because you're taking a piece of the overall profits. Is that the
Right.
reason? Yeah.
Right.
Right.
Yeah.
Peter, it's a problem when I know as many people as I do here that calling people by name.
Yes, Professor Gratz. This is Peter Merrill, PwC. So when you write this chapter of the book, I don't know if you have or not, but you might want to give reference to Chairman Camp's H.R. 1, which has a provision that in Washington has been called Option C, which is actually a unilateral attempt to do this residual profit allocation method. At least that's one way to look at it. Where they are imposing tax on IP income on imports, but only for the foreign subsidiaries of U.S. companies. So there's a big hole, which the multinational community noted, that a foreign-based company selling into the U.S. would not be subject to tax on its IP income. And that's a very significant challenge. And I think Marty Sullivan was raising the question, how would the U.S. unilaterally tax an import from a foreign-based company, a Swiss pharmaceutical company, on this method? How would they figure out the right amount to tax?
This is a transfer pricing rule. And so the answer is that would be the profit that was located in the U.S.
Well, it would be apparently figuring out the routine returns around the world on a product line basis and doing this allocation of the G&A. And yeah, it does seem like it's a significant challenge to do this unilaterally. The other part of option C was to reduce the tax, not to 0, but to 15% on IP on exports and on IP income from foreign market sales by foreign subsidiaries of U.S. companies. So if you change 15 to 0, it actually looks a fair amount like this tax system. There were a lot of comments submitted on option C.
But again, just to be clear, the routine profits would be allocated to the exporter in the United States. That is, it would be you'd get a routine markup on the manufacturing or whatever it is. So it's not 0, it's above 0. It's just
No, on the IP income. I'm saying the Camp option
on the
C
IP
identified
income, yeah.
something that was called foreign-based company intangible income for foreign subs, an
okay.
equivalent measure of IP income for domestic companies, and imposed a 15 rather than a 0 rate. So they moved maybe halfway towards this on the export side. So I'm suggesting that this is worth looking at. Because it is probably the closest thing I've ever seen drafted that's remotely like what you're talking about. So, and there were a lot of comments that were submitted on it, pointing out some of the issues. They did attempt to deal with intermediate goods, for example. So I just would commend to whoever's writing this chapter to kind of look at Camp Option C or HR 1 and look at how it is similar and different.
Okay.
Thanks. Anybody else? Oh, over here. Two people over here. Sorry.
Hi, Harvey Galper. I just have a comment to Eric on his use of the McClure analysis to say that the excise tax effects will change sort of the prices of consumption goods. That effect was based on the fact that there were only normal returns, and so therefore the prices would have to increase in order to generate normal returns. And in this case, it's the supernormal returns that are being taxed. Well, I don't think there would be a price effect. There would just be a somewhat lower after tax supernormal rate of return.
Yeah, I actually think that that's not the case, because basically you're getting a supernormal return on in terms of having a higher value, you got this increased value of the intangible that didn't get taxed. But once you take into account that value, then the question is, where do you exploit the intangible? Do you exploit it in the U.S. where it's not taxed, or do you exploit it, I mean, in what market are you exploiting it? And if you're being taxed more for selling it in market A than selling it in market B, you're going to have to recover more for selling it in A than in B. So I think it's still a tax on the I think it still applies to intangibles for this component of that.
Can I come in?
Yeah.
I think it's quite complicated. Depends, on. I mean, if it really is an intangible, there's no. You could sell it in country A and country B, and it's not, not clear that you have to choose between, which country you're selling it to. So I mean, if you are really thinking it's an economic rent,
but you're not selling the intangible. You're selling the good, which has the intangible input
sure,
embodied in it.
but the tax is only going to be on the kind of rent component, in effect. Well, the tax in that country is
right, but you would still pay a higher corporate tax if you sold to the one country than the other. So presumably you would care about that.
Yeah, I mean,
Yeah.
well, okay, it's
complicated.
it's complicated. It kind of depends what the kind of economic circumstances are, I guess, and
Yeah.
what it is that you're actually
Yeah.
selling.
Really
Yeah.
good to see you three economists disagreeing like this. David, I think
Taking
you're
it out.
next.
David Wentworth, IMF. Michael, you clarified already that natural resources would probably need another tax rather than this tax. But and all of you discussed briefly the issue of exports. But doesn't this system pose a real problem for countries that are primarily export-oriented economies, and or that portion of mixed economies for companies that are large exporters? Because the profits are allocated to the sale.
It's as compared to what, right? I mean, if you look at the next proposal, where you're only taxing on a destination basis, then that certainly will cause a problem for exporting countries. Here, the production country will continue to get the tax on the routine returns. And the routine returns will depend on what comparable returns are for the activities it's providing. So it's not a zero tax, which is the next panel's story for exports.
Right, but those high profit businesses, those economies that are successful exporting all this stuff,
Well, I mean, they'd lose a lot, but remember, it's a compared to what question. They're not getting it now. It's in Caymans or Bermuda or somewhere. It's not like they're losing something that they're now getting. What they're really getting is the routine return profit, and they would keep that. One more question, if anybody has it, or we'll stop. I don't want to be between you and lunch.
Marty Lobel, I'm chairman of Tax Analysts. What I've been hearing this morning is the result of very bright people thinking about very complicated subjects, which are going to provide full employment for the accountants and lawyers for the future to come.
Oh, they're completely full employed already. So.
Why not consider something really basic, like eliminating the corporate income tax and treating shareholders like their employees? Have a withholding of, say, 35%. Notify the IRS what you've done. Put the money in the IRS's checking account, and then whoever the beneficiary is can claim a credit on his or her taxes. And it's very simple administratively to operate. It would encourage people to locate here, and the shareholders would benefit significantly because it'd be no double taxation. The nonprofits would receive no more, no less than they get now because of the corporate tax. And we might have to have a retraining program for some accountants and lawyers, but the country would benefit. Why not something just that simple?
It sounds a lot like an imputation credit form of integration, shareholder integration, which Al Warren and I have an article coming out in the National Tax Journal in the fall about, written a lot about over time. I'm for it. I've been for it. I think it can go with all sorts of other things. I don't think it solves the transfer pricing problem that we're talking about. That is, if the profits are in Bermuda, and you don't have a distribution. I mean, if you put a withholding tax on the distribution, then you'll help solve that problem. But
Well, why not just do it on the profits they declare to the SEC that they earned?
oh well, if you do it on book profits,
Book
that's
profits,
oh, yeah,
eliminate
well,
all the tax accounting. and-
Worldwide book profits.
Pardon me?
Worldwide book profits.
Yeah,
Okay.
profits they declare to their shareholders.
Okay. So why would you set up as a U.S. company then?
I suspect every other country would go to it rather than
Oh,
have
okay.
their country.
Right. Just
there.
got to see if it's incentive compatible. Okay.
They did.
Uh,
They did for a while, and then the European Court of Justice told them that they couldn't do it the way they had done it. But yeah, that's a question that has a longer answer than the wrap-up sign that Ann is holding. So we're going to go to lunch now. We'll be back. Ann, remind me, I don't have my notes.
1:15.
1:15. We'll start the next panel at 1:15, and there's lunch they'll reopen the room, and magically lunch will appear.
Thanks.
Yeah. So welcome to the third session for the day. And in this session, we're going to start with Alan Auerbach, who is a director of the Robert Birch Center at Berkeley. So Alan is going to give a presentation on the destination-based cash flow tax. And he'll be followed by two commentators. The first is Rosanna Alchua, who is Professor and Dean of Social and Behavioral Sciences at Rutgers University. And the second commentator is John Samuels, who is the Chairman of Global Tax at Blackstone. So we'll start with Alan.
Thank you very much, John. As you have already heard throughout the day, our group has put together is developing two proposals. One, the residual profits approach, and the other, destination-based cash flow tax. And you can think of these as two different ways of moving in the direction of relying more on destination basis. One more incremental and one more significant, radical or significant in terms of the distance from the existing tax system. And I think it was made clear in the last session that one of the advantages one might see from the residual profits approach is that it is incremental, that it builds on the existing tax system and it says, well, what is the biggest problem in the existing tax system and how can we deal with that? And the biggest problem was locating and taxing returns to intellectual property, and that was what that proposal was focused on. This alternative is more of a major shift from the existing tax system, but it still does work within the context of corporate taxation, or perhaps one might think large entity taxation, because that is certainly one of the ideas of how things might change under this proposal. This is, although the particular version of the proposal I'm going to be talking about today is one that we have been working out in our group and has certain features that are new, ideas that are newly developed by our group. The origins of this approach go back several years, both in terms of the cash flow taxation and the reliance on a destination basis. And I'll say something about these origins as I present the ideas. The problems to address, well, these have already been made clear in the first session, but I'll just set them out here again to help frame the logic of going in the direction that we suggest. You've got basically two horses in the race, if one doesn't think about destination basis, which is worldwide taxation and territorial taxation. And we know very well what the problems are under the two systems. Under the worldwide system, you have inversions, problems, concerns about international competitiveness of U.S. companies, and with our system of not simply worldwide taxation, but also worldwide taxation with deferral of taxation of foreign source earnings until repatriation, the distortions of the lockout effect. But under a territorial system, which makes some things better, makes other things worse. In particular, makes the problems associated with shifting of profits and activities abroad into lower tax jurisdictions even more severe, because there's no hint that there might ever be a subsequent tax on the differential between foreign and U.S. tax rate upon repatriation. So you have to some people, when they discuss these two approaches as sort of a insoluble problem, and some of the solutions proposed, such as the current administration's proposal, is sort of an attempt to marry the two approaches. That is, it's a sort of, in some ways, enhance the worldwide features of the current tax system, but in other ways move more in the direction of a territorial system. That's not clearly what we're doing in either of our proposals. There are also distortions to investment and finance. If one thinks not about the international context, but just the domestic context, the fact that income taxation raises the cost of capital, and the fact that our particular income tax treats debt and equity very differently, and therefore distorts the choice of how companies' choices of how they raise their funds. And finally, there's complexity and information requirements. And there's already been a lot of discussion today about the full employment of tax accountants and lawyers and economists under different potential schemes. And certainly the current system is one, and many proposals, notably the BEPS approach, that will keep such people employed. The proposal that we're putting forward here has two elements, and elements that we think will deal with the problems that I've just laid out. And these are complementary in that adopting them together, I think, works better than adopting either separately, but one nevertheless can think about them as separate pieces of the approach. The first is a cash flow tax. A cash flow tax literally being a tax on cash flows rather than a tax on income. Perhaps, I mean, I'm sure one could find earlier writings on this, but one of the ones that people associate with this is the writings in the Mead Committee's report in the 70s, which laid out two versions of the cash flow tax. One is an R base that is on real activities, ignoring financial transactions, and the other is a so-called R plus F base, real plus financial, that is treating financial activities, excluding payments and receipts from equity holders, in the same way that real flows are taxed, and I'll say more about that. And then destination basis, there's already been some discussion about that in the previous proposal, but basically worrying about or focusing on where the purchasers are. And that was discussed in the previous proposal, and it's what we're going to be talking about here. And it's the same approach. It's a familiar approach outside the United States in most of the world where VATs exist, because that's the standard approach taken under a VAT. But unlike the VAT, in our approach, we're focusing on business profits rather than value added, the major difference between the two being the value added by labor, which is deductible in this proposal and is not deductible under a VAT. So how do we get from the current tax? You could think about adopting this tax de novo, but I think it's easier, and thinking about the fact that we have this current tax system, think about how you would get there from the current system. Basically, to adopt a cash flow tax, you would replace depreciation with immediate expensing, and then you would eliminate interest deductions. That would be an R basis. Just forget anything to do with debt. Alternatively, if you wanted to include financial transactions in the base, you wouldn't touch interest deductions, but you would introduce a new provision, which would be taxation of net borrowing. And that's, in present value for a loan at a sort of normal rate of return, those would have the same effect, because deducting interest and paying tax on borrowing as opposed to not deducting interest and not paying tax on borrowing would have the same present value. The difference arises in the case where there are profits being made in the financial transaction, and that's will have to do with how you're treating financial institutions, and that's why it matters. I'll say more about that. The destination basis basically is, one can think about it as one of two ways. Well, first of all, as under a territorial tax system, purely foreign transactions are ignored. So it's territorial in the sense that an activity that a U.S. company does entirely in a foreign country, produces in a foreign country and sells in a foreign country, that would be ignored. That would be ignored under a territorial system. It would be ignored under this system. There's an additional step, though, which is that cross-border transactions, that is either going out of the U.S. through exports or coming into the U.S. through imports, would effectively be taken out of the tax system. Now, under VATs, they're in the tax system, but then there's an offsetting border adjustment. So that is, revenues from production are taxed, and then if the company sells abroad, that tax revenue is credited back. through a border adjustment. The reverse is true with imports, that they aren't taxed when they're produced, but then they're taxed when they're brought in. And then deductible. One can also think, and I tend to think about it this way because I'm not from a VAT country, so I'm not accustomed to doing things under a VAT, as just taking these transactions out of the tax system entirely. That is, instead of saying U.S. company produces, pays $100 in tax, and then the $100 is forgiven when the good is exported to France, just say revenues from exports to France are not included in the tax calculation. It's exactly the same effect. It's just a question of whether one thinks of it as having two offsetting transactions or no transaction. So, okay, what's the justification for each of these approaches? Well, why cash flow taxation? Here there's a distinction. There's a lot's been made of in the economics literature between normal returns to capital and taxes on rent. And it's particularly salient in the current environment where normal returns to capital are effectively zero. And you know, if you think, what do you get from investing at arm's length in safe assets? Well, you get, if you're lucky, you get a zero nominal return, probably a negative real return. And of course, corporate profits are pretty high. What's the difference? Well, the difference is the difference between the corporate profits and corporate profits minus the normal return to capital. But you know, in terms of what drives marginal investment decisions, where you're not, you know, taking account of the profits that you're making on existing investments, well, those will be more affected by normal returns to capital, and so by not taxing the normal return, you would not be discouraging investment. The other thing about the cash flow tax with the change in the treatment of interest is that you're leveling the playing field between debt and equity. And it's also simpler to administer, leaving aside the other economic effects, because you're not keeping track of asset basis, you're not capitalizing anything, you're taxing on cash flow. You're in the words of Woodward and Bernstein, you're following the money. And it's easier to follow the money than to follow the accounts. Why destination basis? Well, thinking about it in terms of foreign cross-border transactions being out of the tax base makes it clear why incentives for profit shifting go away. You can't do anything with a foreign subsidiary. You can't borrow from them. You can't sell to them and have any effect on U.S. tax liability, because those transactions aren't in the tax base. And the tax base is based on the location of purchasers, and so anything you do to relocate your activities or relocate your reported profits is going to have no effect on U.S. tax liability unless that activity also includes changing where your purchases are located. So if you move activities to a foreign country and then you increase sales in the foreign country, well, that will change your tax consequences, but because of the change in the location of sales, not because of the location of reported profits or actual activities. And it's simpler to administer. Here, I want to make a contrast not only with the existing system, but the system discussed in the previous session, because it only depends on domestic transactions. So unlike anything that, say, relies on formula apportionment, where you say, okay, what fraction of worldwide sales are in the U.S., you don't need to do that here. So you don't need to have any information on worldwide profits of an entity or location patterns of factors, because nothing beyond the United States, if this is the United States that's adopting the proposal, would be involved in the calculation. Everything stops at the water's edge, because nothing cross-border and nothing abroad is relevant to the calculation. Now, let me, now that I've laid out how it works and what the basic motivation is, let me just make several comments about how the system would, what the properties of the system would be. Well, first of all, there's no business level tax on U.S. source income. I mean, you could think of, it's a cash flow tax, so there's no tax on normal investment, normal returns to investment. And the fact that it's a destination-based tax means that locating production activities in the United States has no effect on U.S. tax liability. The only determination of U.S. tax liability would be the location of sales in the United States. So if you have an operation which is selling half of its sales are in the U.S. and half are in the United Kingdom, and you're operating in the United Kingdom, and now you shift to the United States, it's going to have no effect on U.S. tax liability because it's the location of the revenues from sales that determines where your taxes are going to be. There's no incentive for governments to reduce the tax rate to attract business or profits. Now, Mike Devereux in an earlier session talked about the lack of tax competition under the VAT, and this is basically the same story here. By imposing what is basically a consumption tax with an exclusion for wages, means that to compete on the tax rate would be as if you were competing on the sales tax. I mean, so think about the U.S. States competing on retail sales taxes. That's not typically the way tax competition works. They compete for location of businesses. They compete perhaps on income tax provisions and providing special tax breaks for companies in terms of location. You don't see tax competition in the U.S. About retail sales tax rates, and likewise, you don't see it in the existing VAT countries over the VAT rate, and the same story would apply here, or should apply here. Again, this is assuming that consumers aren't going to shift from one country to another because of small differences in the tax rate on consumption. As I've already mentioned, the system is equivalent to the combination of a broad-based consumption tax, a VAT, but in terms of the way it's actually implemented, but in terms of its economic effect, also a retail sales tax, and an equal rate subsidy to payroll. So one could think about this in countries that had a VAT, and this has been something that comes up in our report. You could think of doing this incrementally by, say, increasing the rate of VAT and reducing the rate of payroll tax. It would effectively be the same, have the same economic effects, although it would be more of an incremental approach to what we're doing here than just sort of adopting this full tax. But this is what it's actually doing. A way of thinking about it, in terms of what its economic effects are, it's as if you imposed a consumption tax on consumption that is financed by sources other than wage and salary income. So that's, not that you could actually do it that way, but if you could sort of, go out there and see how people are financing their consumption and said, okay, I can see you're financing it from wage and salary income, I'm not going to tax that consumption. Well, of course, you can't do that, but effectively you're doing the same thing by giving a deduction for wages, that is, by excluding wages from the tax base. Now, related to that, it means that the system is going to be highly progressive, and there's really two parts of the story here. The first is just the direct effect of exempting wage and salary income. If you're exempting wage and salary income, then you sort of overturn the usual concern about the lack of progressivity of a sales tax or a VAT. So the usual argument is that consumption tends to fall with income, and so if you impose a tax on consumption at some constant rate, it's going to be less progressive than imposing the same tax on income. Now, there are issues with that conclusion based on horizon, whether that's true if you think about people over a longer period than just a year, but just taking that at face value, that conclusion no longer applies to this tax, because what you're taking out the consumption financed by wage and salary income, which of course is distributed less toward the top of the income distribution than other kinds of income. And so this should be a very progressive tax on its face, just by the way it's constructed. Moreover, because it is not a tax based on the location of production, you've removed the incentive for capital to flee, to go to low tax jurisdictions, for profits to be reported outside the United States, and force the government to come up with revenue from other sources. And that effect should also lead to a more progressive tax system, because it means that unlike the existing corporate tax, which as discussed earlier, some people will say a lot of it is borne by labor, there's no reason why this tax would be borne by labor, because there's not going to be any capital flight resulting from it. And nor will there be any profits flight, because profits aren't being based on the location of production. Getting to the issue of incentive compatibility, this approach should be self-reinforcing. One of the problems of international tax agreements in general, with the BEPS project, with tax treaties, in general, agreements to sort of impose taxes that work, well if everybody does it, is that there's often an incentive to deviate. One of the issues that's come up in the European Union, for example, is that some of the older economies with higher tax rates want to get some of the newer economies with lower business tax rates to impose higher taxes. And of course, the countries say, well, why? No, we don't want to do that. We want to attract capital. And there's always going to be an incentive if you're competing over capital and you agree, well, we're all going to have tight rules and tax our source-based income heavily. There's always going to be incentive for some countries to say, well, if we lowered our tax rate just a little bit, we could attract a lot of capital and profits from other countries. That dynamic doesn't exist here, because if a country like the United States adopts a system like this, whether it does so in agreement with other countries or whether it does so unilaterally, the other countries will have a stronger incentive to adopt the same system because the U.S. has done it. Whereas in the usual world of tax competition, if countries agree to try to stiffen the tax rules, there's going to be incentives for some of the countries to actually renege on that commitment. And the basic reason is that if the U.S. is no longer imposing a tax on U.S. source income, that is going to make other countries fear that their tax bases are going to be eroded and go to the U.S., where they won't be taxed. And that's not just true for high tax countries. That would be true for Ireland. Because if you're a U.S. company with a subsidiary in Ireland, and under this new system, you engage in a transfer pricing transaction which causes less income to be reported in Ireland and more in the U.S., you're going to reduce your worldwide tax bill, even though Ireland has a very low tax rate. Because the U.S., whatever its corporate rate, it could still be 35%, will not have a higher tax burden imposed on that company as a result of more of the profits being reported in the United States. Okay, now, in the time that remains to me, and probably I won't have enough time, let me just talk about 5 issues that come up in implementation, assuming that I've fully convinced you that this is something we should do. The first, perhaps the most important in terms of what our group can contribute, is taxing financial services. So this is a problem. Existing VATs are basically real-based, based on real transactions. And if you think about the VAT's introduction in the 1950s, and the VAT in turn grew out of reform of turnover taxes, it was based on an industrial society and industrial economies of an earlier era, where value added in the financial sector just wasn't nearly as big as it is now. And it's still a struggle under existing VATs to tax the financial sector adequately. And the basic problem is if you just ignore financial transactions, then those financial companies are going to be outside the tax system. And so you're not going to be collecting any revenue from them. Now, including all financial transactions would solve that problem. For example, if you have the so-called R plus F base, if you're a financial company and you borrow $100 and you immediately lend $100, the borrowing and lending would cancel out in the tax calculation, but the interest would still be in the tax base. And so if you lend at 5% and borrow at 2%, the 3% spread would be in the tax base under the R plus F base. And so that you would accomplish what you want, which was to include the profits from financial activities. The problem, or in general, with an R plus F base is it's a lot more complicated because it requires not just financial institutions, but everyone who has borrowing or lending, every business that has borrowing or lending, to do that additional calculation. And it would go beyond the current system, which includes just interest. It would include borrowing and lending as well. There, the second problem is that under a destination-based tax system, treatment of financial transactions would be different if they cross borders or not. And particularly for financial transactions, that might be difficult to keep track of. And we thought about this a lot in our group. You know, what if I'm a U.S. company, I borrow from a foreign company, and then that loan gets resold to a U.S. holder? Or vice versa, I borrow from a domestic company, which is in the tax system, and so there's no border adjustment, but then that loan is sold by the U.S. lender to a foreign financial institution. We would need we would need to have adjustments to those secondary transactions. And while in principle it could be done, we felt that this added complexity to the system. But we came to the conclusion that a full R+F approach isn't needed to capture these rents. And the basic story is that if you have two business taxpayers in the US, say a financial company and a non-financial company, the full R+F treatment would say that they have sort of the tax treatment of a loan or any financial transaction that one of them makes with the other are going to be a mirror image of each other. So if a bank loans $100 to a non-financial company, the bank gets to deduct the amount that it's invested in the loan. That's what happens under a cash flow tax. And the borrowing that is done by the non-financial company would be included in the tax base. And then interest payments go the other way. The non-financial borrower would pay interest and repayments of principal. That would all be deducted. It would all be taxable to the financial institution. Well, assuming you have a single rate tax system, which is what we envision, the net tax consequences for the two companies are zero. So why not just forget about them entirely? And if you forget about them entirely, then what are you left with? Well, all you're left with is transactions between financial institutions and non-business U.S. Entities, so households, possibly nonprofit institutions, depending on how you want to deal with them. You don't have to think about foreign entities, because with the destination basis, a border adjustment would take that stuff out of the tax base anyway. And so you're left with a very, very small share of the domestic activities that involve financial transactions. Everything that involves business-to-business transactions would go away. Everything that involves U.S. business to foreign entity transactions would go away, and all that would be left would be U.S. business to U.S. non-business transactions. And we wouldn't, and on the cost side, you know, that is real costs, you know, businesses that, you know, hire workers, buy furniture, and do other things, the netting of their revenues from transactions with non-financial companies would have no implications for their ability to deduct these expenses. And so those calculations would just remain untouched. However, as would come up in that case, and more generally, when you're dealing with a destination-based system, the potential problem of persistent tax losses is more serious. Now, under a pure income tax, you know, the only way you're going to have a loss is if you don't have income. It's been noted for a long time that if you have investment incentives and other things like that, you can be a company that is profitable in an underlying sense and still generate a tax loss. And that's been a problem. But it gets worse under a system like this, because you could be a company that you know, basically generates no revenue at all that's taxable. You know, imagine that you're a domestic producer and you're producing entirely for export. Well, all of your costs are going to be deductible in the U.S. All of your revenues are not going to be taxable because of the, you know, netting of the border adjustment and the tax on revenue. And no matter how profitable you are, you can be enormously profitable. Year after year, you're going to be reporting a negative tax liability. Now, one of the thoughts that we had, how do you deal with this? Well, you know, you could say carry forward with interest, which is a solution economists often propose. I don't think that's going to be enough here, because, again, if you're exporting and you're exporting every year, that carrying forward forever isn't really going to be helpful. Now, there are failed experiments in the past with transferability of tax losses. I think probably a more promising approach would be to allow other taxes for which the business remits to be used to credit tax losses. For example, business is paying payroll taxes. It's remitting more payroll taxes than it's directly responsible for because in the employee portion, perhaps such taxes could be used to offset losses generated by this tax system. But that obviously requires some thinking. Revenue, there's some people here from the Treasury who are working on this right now. Some rudimentary calculations I did in a paper I did for the Center for American Progress in the Hamilton Project almost 6 years ago. I did some what I would call back of the envelope calculations based on aggregate flow of funds accounts, which suggested that it's not obvious which way the revenue would go at a given tax rate if you went to this system. There'd be some provisions that would increase revenue, other reforms that would reduce it. There are additional things that would increase revenue, like the border adjustments themselves, because the U.S. has a trade deficit, would increase revenues. The inevitable transition relief provisions would certainly cause revenue to go down. You could increase revenue by extending this tax system beyond the C corporate sector to large non-C corporate entities. You could raise revenue, as reference was made to the Camp proposal already, through one-time tax on offshore earnings, existing offshore earnings, which of course would no longer be subject to tax on this under this proposal. And finally, I guess I would say that because of the lack of incentives for tax competition, the government could keep its 35% tax rate under a proposal like this, whereas most of the discussion of other reforms is typically centered on lowering the corporate tax rate. Reference has already been made to taxing. Mike talked about taxing natural resources in the previous session. I'll say that here too. If you move to a destination basis, one of the things you're giving up is the tax on rents that are associated with local domestic production. Now, in most cases, we say, well, that's okay because we're not really successfully taxing those rents now anyway. I mean, Apple may be generating a lot of rents in Silicon Valley, but they're not showing up on Apple's tax return. But of course, it's going to be different for an oil company that's drilling in the United States. Those rents, profits from natural resource extraction, it's pretty easy to identify them from where they come from. And particularly for countries that rely heavily on natural resources, you'd want to do something on that. I'll just mention as a cautionary tale what happened in Australia. The Henry Review, which was led by Ken Henry, the Treasury Secretary in Australia, just not long ago, proposed a very well thought out origin-based cash flow tax. So it was a cash flow tax, so it meant to have all the other benefits of cash flow taxation, but on an origin basis to hit natural resources that were being extracted in Australia. And when that proposal was put forward under the government of Kevin Rudd was driven out of power by his own party and ceased to be the prime minister. So that, I guess we've now had two examples of what can happen today on what can happen in parliamentary systems. And finally, the WTO. In the earlier session, Michael, channeling Itai Grinberg, talked about the distinction between that proposal and this one in terms of vis-a-vis the WTO. So one of the things that's clear is that the WTO rules permit border adjustments under VAT. Now, the destination-based tax is equivalent to a VAT plus an equal rate reduction in payroll taxes, both of which are WTO compliant. So an economist would say, I have enough information, this must be WTO compliant. But that's what an economist would say, right? Economists don't run the world. So is a destination-based tax WTO WTO compliant? Well, in general, our group has come to the judgment that there would be serious issues with respect to WTO rules. One having to do with the fact that this is direct tax rather than an indirect tax. The other having to do with the fact that there is a deduction for wages, which VATs don't have. Now again, neither of those issues, from an economic perspective, neither of those issues should be relevant. They have no bearing on economic outcomes, but that, certainly in the short run, as one confronts the existing rules from the WTO, that matters. The majority in the House Ways and Means Committee has come out with a very closely related proposal to the one I've just laid out in the last few weeks. And in the document they've released, they take the position that this general approach would be WTO compliant because it is basically a tax on consumption. So I guess one way of interpreting what they're saying is that they're taking the view that an economist would take, which is to say, this looks like a VAT and a reduction in wage taxes. Those two things are WTO compliant. Why shouldn't this be WTO compliant? I can't say any more on that, except to give you my final thoughts, which is that I think that, and as has already been discussed today, particularly in connection with the BEPS project, under the existing system we have in the US and other countries, and by that I mean not only the existing system, but a system modified to incorporate the various action items of the BEPS project, we're going to continue to have tax competition. Introduction of provisions to lower tax burdens and reduction in rates to lower tax burdens. And I don't think a simple shift to territorial taxation or strengthening worldwide taxation is going to have much of an impact on that. Now, the approach we are proposing in this particular proposal, I don't think it would end tax competition. As I said, if the U.S. adopts a system like this, it would actually put pressure on other countries to adopt such a system. Now, some might react to that and say, well, so there's tax competition here as well. But the important distinction I would draw is that the competition here would be tax system competition, not tax base or tax rate competition. It would be basically saying we found a better tax system, a more rational one, and if we adopt it, it's going to put more pressure on other countries to do the same thing. And what's the difference between the two types of tax competition? Well, under the other kind of tax competition, all the countries end up with no tax base or no tax revenue. They all keep lowering their corporate tax rates. They end up with just lower tax rates, and the corporate tax base is the same, and they just have less revenue. Under this approach, the end result, if every country adopted a destination-based corporate tax system like this, would be a very stable tax system in which individual countries could choose their tax rate based on revenue needs and not have to worry about flight of their corporate tax base. So in that sense, I think it not only is incentive compatible, but I think it sort of lays out how, through tax reform, countries could get to a much more stable situation. Thanks.
Thank you very much, Alan. And now we'll have our first commentators, Roseanne.
Okay, well, thank you very much for inviting me to be a discussant here today. This is a tax that is near and dear to my heart. I spent most of 2005 working as the chief economist for the President's Advisory Panel on Federal Tax Reform. And on the first day, thank you. On the first day that the staff met with Eddie Lazier and Jim Perturba, we decided to consider David Bradford's X-Tax as an option. We were very excited about that. And the cash flow tax is the business side of the X-Tax. Like the proposal that we're considering today, we felt strongly that it should be destination-based, and we grappled with the border adjustment issue. We ultimately, for those of you that have forgotten, we ultimately recommended a reform that we very uncreatively called the Growth and Investment Tax, the GIT, and that included a destination-based cash flow tax for businesses, and we did that even though we knew there would be WTO problems. So I very much enjoyed revisiting all of the issues we worked on. It brought back many, many memories. This chapter discusses carefully all of the implementation problems of a destination-based cash flow tax. And I felt that it went further in its analysis of some issues than we did. For example, what Alan was just talking about, the incentives for countries to adopt the tax in a world with tax competition. There's a great discussion of the treatment of financial flows, a great discussion of incidents, better than we did for sure. A very interesting discussion of how the tax could be introduced in a country that already has a VAT, which wasn't of concern of ours, of course, but a very interesting conversation, very interesting discussion. So I think it makes sense in my comments today to hit on what I see as what's missing from the analysis, and very little, in fact, I think is missing from the analysis, and what issues I think deserve more attention or are worth calling out in the discussion today. So let me turn to my comments. So in terms of what's missing, I would add a short discussion of the treatment of royalties. Maybe the treatment of royalties is obvious to everyone, but it's really not mentioned in the chapter. Royalties received from abroad represent payments for exports of intangible assets, and so they would be exempt from taxation under the destination-based cash flow tax. The owner of the intangible would be taxed only when she uses the proceeds to consume. On the other hand, royalties that are paid for foreign-created intangible assets would not be deductible, that's the other side, since they're payments for imports. So transfer pricing problems, as we all know, may be particularly severe in the case of royalties because it's difficult to establish arm's-length prices for intangible assets. So the destination-based cash flow tax closes down opportunities to inappropriately set transfer prices on these assets, since the prices established for cross-border royalties transactions are out of the tax base. So that's a great thing and it's very attractive, but I think we should all make sure we understand that royalties aren't going to be taxed. So there's 4 points to make here. First, we wouldn't need a patent box if we had a destination-based cash flow tax. So if you like patent boxes, you'll love the destination-based cash flow tax because it taxes royalties at a rate of 0. So unless you wanted to go further than that, you're really going to like this. And you might. Second, this means that destination-based cash flow tax is better than territorial. Royalties are taxed in dividend exemption systems, and passive returns would also escape taxation under the destination-based cash flow tax, which is not the case under dividend exemption systems. After all, this is a consumption tax. But again, I think that these are points that are worth making. Third, in the discussion of revenue under this destination-based cash flow tax, the authors appeal to the JCT's revenue estimate that dividend exemption, moving to dividend exemption, would raise revenue to get a gauge of the consequences of including only domestic transactions in the tax base. So they appeal to the JCT estimate, but the JCT estimate, I assume, assumes that royalties and passive income would be taxed. And they wouldn't be taxed under the destination-based cash flow tax. And then they use, cleverly, the border tax revenue estimate from the tax panel report, but that didn't take royalties into account, I'm quite sure. I think it was exports and imports of goods. So I think that the destination-based cash flow tax would raise a bit less revenue than assumed. This may be a nit, but again, I think it's worth discussing. Finally, just making sure that I really make sure everybody understands this. By exempting exports, we're giving up the tax on the normal and economic returns on US-based intangibles to the extent that they're consumed abroad. So we really aren't, so now you could say we do that already, and I think that's what Alan said, but again, this should be made crystal clear. It's, I guess, as somebody that worked on the GIT, I thought maybe, I wasn't sure that you could ignore the personal side. So I question whether we can ignore thinking about the personal taxation of capital income when we're thinking about the neutrality properties of the cash flow tax. I'm not entirely sure you can do that. I could be wrong. But isn't it the case that neutrality between the choice of debt or equity requires that interest payments and the normal return on equity are taxed at the personal level in the same way? So if capital gains are taxed upon realization while dividends and interest payments are taxed on accrual, the debt equity choice, I believe, will be distorted. You would need capital to be taxed on a cash flow basis, also capital income to be taxed, or capital cash flows to be taxed on a taxed on a cash flow basis, also at the personal level, to leave the debt equity choice undistorted. So those are some of the what I feel might be missing from the analysis. But let's move on to implementation issues. And I think Alan made really clear in his comments that there's a lot to like with cash flow taxes. I agree. It's not surprising that many careful study groups have recommended this form of taxation for businesses. A question then that you must ask is why we haven't seen these implemented in the real world. And I think that there are a variety of issues that we've already hit upon. And one is losses. They need to be fully refunded if you want to keep the neutrality properties of the cash flow tax. That just has to happen. You also need to have tax rates that don't change over time, of course. And export refunds must be received to get the benefits of border adjustment. If they're not, you don't have a border adjustment. You don't get the benefits. And as Alan said, the losses that are likely to be generated under the cash flow tax are a big problem that needs to be grappled with. They've thought about the issues, and they've suggested allowing offsets against other taxes, for example, payroll taxes, which is an intriguing idea. I wonder if it would fly politically. We also grappled with this with the tax reform panel and decided to go with a system of carry-forwards with interest, which is not the right answer. However, if you wanted to take taxes out of the investment, location, and corporate residence decisions. However, it's a rough justice tax provision that may be called for in the real world if we were to enact a cash flow tax. But again, it does destroy some of the properties of the tax. And it still leaves the problem that Alan talked about, which is the persistence of losses, especially with exporters. I should note that we were wary of and didn't recommend provisions that would allow the trading of losses. So I think this is a major design issue. On revenue, I should point out that tax revenues could decrease temporarily in times of high growth. And there also could be substantial variation over time in tax revenue if individual projects are correlated. So if good luck in one project doesn't necessarily offset bad luck in other projects. So there could be big things are going to be different in terms of revenue. In fact, we were saying we're never going to see a situation in which we don't need accountants and economists, but this is the revenue estimators are going to be having a lot of fun on this one, I think. As far as WTO concerns, I think everyone in this room believes that the cash flow tax should qualify for border adjustments. It just should. But I just think asserting the case is just not enough with the WTO. The authors themselves say that the tax is unlikely to be found to be WTO compliant. I think that a country that wants to adopt this tax is going to have to spend a lot of time educating their trade representatives, who are lawyers. Nothing against that, but they don't automatically say, "Oh, that's an indirect tax. That's not a direct tax," and they have to hope that what at first glance looks like an export subsidy isn't called an export subsidy. The trade negotiators do not want to go through another round of FISC ETI, but maybe the ones that did that have already retired and they'd be quite happy to do this again. And then there's this, maybe this is a small problem, but foreign companies that come from worldwide countries that are trying to get income tax credits based on cash flow taxes paid, what happens there? There may be very few of them left, but it's something to think about. Avoidance and evasion. One always needs to think very carefully about this with a new tax. And Mark Mazur was talking about this. You have to stress test it. So what are the new loopholes? On the panel, we were always, and I don't want to just say afraid, we were really afraid of taxpayers backing up their trucks to the loading ramps of Treasury and just clearing out the place. We didn't want to be the people that put forward something that just opened up the floodgates. So here are some of the things that I worry about, and I'm not saying that this would be, some sort of a rape of the Treasury system, any of these things, but there are things that I worry about. The problem of firms disappearing after claiming losses, whether we would need to impose a minimum holding period on assets to qualify for expensing, Exports and imports, the government, now these are problems that are similar with the VAT, but the government needs to decide which goods are actually exported and imported to prevent avoidance and evasion. So it's just important to recognize that you trade off solving some problems with creating some new ones. They're not new if you already have a VAT in terms of exports and imports, but the stakes would be higher since the refunds are now bigger. Non-registered firms can be used for imports, and that's a particularly vexing problem for internet sales and other businesses that have minimal U.S. presence. On services, you have to determine when and if services have been exported, and that could be difficult, but it's similar to a VAT. But I'm thinking about law firms, accounting firms, engineering, management consulting. And then the government needs to monitor deductions and exemptions. They need to check to see if goods are actually exported and if inputs that are deducted from the cash flow tax are indeed bought on the domestic market. Now, maybe I think that has to be done. The point is that there are new evasion opportunities, so you might need some, we have title of passage rules, but you may need title of passage type rules to make sure that exports are actually exported. There's the tourist problem. I think that's what David Bradford called it, where one can consume foreign-made goods abroad to avoid the consequences of the tax on imports. That may not be a big problem, but that, I think, gets, there are these problems. Now, I wonder, using the R-base requires a distinction between real and financial flows. I think that creates tax avoidance and evasion opportunities, but maybe they're not as big as I would have thought. Employee stock options, how will they be treated? Do you need a wage to distinguish? Do you need reasonable compensation rules for wages? Yes, I know I have to wrap up. Inventories. Just a couple more points. Transition is going to be hard and it's going to be costly. You may have to have two systems. If you're going to phase out depreciation and interest deductions and carry forwards, you might want to you might have to keep that system while you're phasing in expensing. Then I just wonder if countries with VATs will be, two more points if I may. If countries with VATs are going to be interested in this. So they're saying, okay, well, I already have the VAT. That's a credit invoice VAT. And now I'm going to adopt a subtraction method VAT with a wage subsidy. So it does have a lot of great properties, but that's really what you're selling here. And I really do like don't get me wrong, I really like this tax. I just think it's my job to do this. And then final point is you want to, not that I'm getting paid anything, but we want to look at the efficiency gains, simplicity gains, distributional consequences compared to other reforms, like just lowering the corporate income tax rate by adding a VAT, or with VAT countries that have VATs, raising the VAT rate and decreasing the payroll taxes. How does this compare to just shifting the taxation of capital income to the personal level from the corporate level? So in short, I'm a fan, but I worry about the issues that I've raised. In theory, this thing is great. In reality, there are definitely some problems, but that's what you have with the tax system that we have now. They're pretty bad. So thank you.
Thank you very much, Roseanne. A lot to think about. And now to our final commentator, John Samuels.
Thank you, John. And is this on?
Now it is.
Now it's on, I'm sorry. Thank you. I think we can all agree our tax system is pretty bad. I think the good news is there are a lot of new, fresh ideas around for how to fix it, including, I guess, Eric Toder and Alan Viard's sort of accrual-based tax system, the integration that's being considered in the Finance Committee. Roseanne and Harry have a paper on integration. Michael Gratz's, I don't know that it's new anymore, but it's withstood the test of time. Notion of adopting a VAT and using it to reduce business taxes and simplify individual taxes. But when two important players in the tax policy world, like the living legend Alan Auerbach and the Republican chairman of the Ways and Means Committee, Kevin Brady, who I think it's fair to say are from opposite ends of the political and policy spectrum, agree on a proposal for reforming the U.S. tax system, it is time to sit up and listen. And I have to say, I have always been a fan of destination-based taxes. for a couple of reasons. One, as an American, one of the last things we have left is our big market, and we ought to use it and leverage it. And secondly, as a somewhat reformed tax planner, lawyer, for most of my career, I've understood I could reduce taxes by changing where the production of goods occurred, where intangibles were owned, where debt was incurred and interest deducted, the countries in which corporations were incorporated. But the one thing I could not change is where my customer was. But instead of extolling the virtues of destination-based taxes, which I like a lot, and I like this tax a lot, I want to talk about some of the real-world challenges in implementing it. And it, or really, to my mind, the Brady blueprint proposal is very close to this tax. First, whether it would be WTO compliant. Second, the challenges posed by denying interest deductions across the board, particularly in a global economy. And third, the challenges presented by the large structural losses that would be generated. Starting with WTO compliance, it's the elephant in the room. I think we all know, and I'm not going to spend I'm not a trade lawyer, but we all understand the intuition that the WTO doesn't want tax systems to be used to provide, to discriminate against imports or to provide subsidies for exports. And at first blush, this tax does exactly that on its superficially. You've got when you have an import, the tax is being imposed on a broader base because wages are not deductible, whereas on goods that are produced domestically and consumed domestically, you get a wage deduction, just a higher tax. Exports, you get 100% rebate of the tax at the border if the good is sold here, if it's produced here and sold in the U.S., subject to full tax. We know our track record with the WTO has not been so good on these issues, starting with DISC, then FISC, then ETI. And I understand Alan's argument. I agree with him that this is the same as a VAT with a credit for payroll taxes, but the trade law, like some places in the tax law, seem to be an area where form matters. And finally, it's worth noting, I don't think the WTO has yet ever ruled on whether a pure subtraction method VAT would be WTO compliant, although it would be a lot closer to it, a lot stronger. But it would not help the WTO analysis if, for example, the Brady Bill were passed and the U.S. became the world's most attractive place to manufacture. And just think of it, a 20% tax rate, expensing, exports exempt. It sounds pretty attractive superficially. And Alan suggests in his paper other countries might follow our model. I think they would, but that would not be their first move. Their first move would be to challenge us in the WTO, and because they already have a somewhat competitive tax system where they can get their VATs rebated at the border. So I think the only thing that's clear about the WTO question is that the answer is unclear. So what do we do about it? What should Chairman Brady and the Congress and well, one thing is we could just bull ahead. We could do what we did with FISC ETI and DISC and just enact this tax and wait and fight the inevitable WTO challenge. Several problems with that approach. One, during the pendency of this period, companies would not be very likely to make investments or change their behavior in response to this tax because they wouldn't count on it, wouldn't trust it. And certainly, so they'd wait until the outcome was clear, which could be 2, 3, 4 years. When the outcome was clear, when the WTO did rule, the U.S. would be faced with two pretty unattractive options, in my view. One, ignore the WTO ruling, blow up the WTO, something that a President Trump might be inclined to do. Maybe even a President Clinton with prodding from labor unions and protectionists. It would be a tough decision. Or secondly, open up tax reform again, re-reform the reform, put Humpty Dumpty back together again. And that would be harder then, depending on how we constructed our tax reform, particularly if we used the revenue raised from taxing imports. We have a trade deficit of about $500 billion a year at a 20% tax on the Brady bill. That's $100 billion a year, $1 trillion over 10 years. He spent that in his bill. If we have to re-reform the bill 2 or 3 years from now and we're start $1 trillion in the hole, there goes your 20% tax rate. There goes a lot of the things people like about the Brady bill. Another option would be to try to renegotiate the WTO rules. And I'm actually sympathetic to that, reopen that discussion. These rules were put in place in 1955 and 1960, at a time, frankly, when the U.S. was asleep at the switch. But they were okay to be asleep at the switch because VAT rates then were 2 to 4%, and they applied to about 1/6 of traded goods. They were kind of a ho-hum. Well, the U.S. woke up in 1968 and started to try to reopen this issue. The Finance Committee called it a major blunder. But starting with the GATT Working Party in '68 and every round since then, we have been rebuffed by the Europeans. They like the status quo. We have been unable to renegotiate our trade agreements to reopen this question. Not saying again President Trump or President Clinton, who wanted to push blowing the WTO up to the brink, wouldn't be successful in doing that, but so far we haven't been. Which leads me to the my final option or solution, which is we don't want to blow up the WTO, and let's assume we can't be successful in renegotiating the rules around border adjustability. Why not change the destination-based cash flow tax to not allow a deduction for wages? That's the principal feature of the tax that makes it WTO suspect. And that is turn it effectively into a subtraction method VAT. I wouldn't call it that, but it would have a much better chance to survive any WTO challenge. It would have all the good properties of Allen's tax. Denying a deduction for wages would raise an awful lot more revenue than this tax, because wages are about 70% of the input of most goods. And as my friend Peter Merrill has suggested, we could take this revenue and use it to, for example, completely repeal all payroll taxes, 16.2%. We could repeal the investment tax, the Medicare tax, 3.8% tax on investment earnings. We could shore up the Social Security and Medicare trust funds, which are scheduled to go bankrupt in 2035. And these changes would provide relief to labor income. They'd make the tax more progressive and remove the principal reason for its WTO, it being potentially not WTO compliant. So why not make such a change? The answer is only one reason I can think of. It would make it look closer to a VAT, a substitution, a subtraction method VAT. And of course, the problems with VATs aren't that they're aren't economic problems, it's that they're political problems. And maybe if we see the growth potential from this tax, it's opened up the door to the Republicans, and they see this as a replacement for all business taxes, not a complement, not to the income tax, but as Chairman Bill Archer used to like to say, he wanted to rip the corporate income tax out by root and branch. Let them rip it out and replace it with this tax. The Democrats would have to be convinced that this tax was not regressive and that it would create more growth. But it would, that may be possible. And a VAT would certainly have many advantages over a destination-based cash flow tax with wage deductibility. It would be WTO compliant for sure. Much easier to administer and enforce. I mean, one of the enforcement features that Roseanne didn't mention is if my inputs were imported, I couldn't deduct them. If they were domestically made, I could. Enforcing that would be a nightmare for the IRS and taxpayers. And the financial accounting aspects of this tax are very, would be pretty radical. Just imagine the huge permanent book tax differences. Imports would not be deductible for tax purposes, but would for book purposes. Exports would be includable in income for book purposes, but not tax purposes. Interest, presumably, would be deductible for book purposes but not tax purposes. So the answer is a VAT, not call it a VAT, would have a lot of advantages over this tax. Quickly, let me turn to another problematic aspect of this tax, which is the denial of interest deductions across the board. And the first and most obvious question is, why do that? I can understand why you might want to do that if it was going to help, if we didn't have a deduction for wages, to try to make it more like a consumption tax or value-added tax. But here we have a deduction for wages. So what is the argument for denying a deduction for interest expense? It is not to make it any more WTO compliant. That is a binary decision. You're either compliant or not compliant. It's kind of like you can drown in 6 inches of water or 60 feet. Getting closer to shore doesn't help you with WTO compliance. Now, several reasons have been advanced for denying interest deductions that are really unrelated to moving to a consumption tax. One, for example, that interest deductibility results in increased leverage. Interest is deductible, dividends aren't, therefore companies are over-levered. That's a very nice talking point. We all understand it. One problem, it is not supported by the evidence. It just simply is not supported by the evidence. Indeed, any empirical study that's been done by economists have shown U.S. companies are under-levered, not over-levered. Merton Miller did a study showing over 3 decades that the debt-to-equity ratio of non-financial corps didn't change when tax rates have changed, even though the financial value of interest deductions quintupled. A guy named John Graham at Duke did a prize-winning paper showing U.S. companies are leaving a lot of money on the table by not levering up enough. Mihir Desai recently testified and did some work showing that the U.S. non-financial companies are way under-levered, and indeed their net debt, their debt minus cash, is at historic and unexplainable, the ratio of net debt to assets levels. Not clear over-leverage is a problem. Negative tax rates. People say you should deny interest deductions because they'll result in negative tax rates, especially when combined with expensing. And they say it in their eyes open wide in horror. And I'm reminded of when the police captain in the movie Casablanca walks into the cafe and says, "Gambling, I'm shocked there's gambling going on here." Negative tax rates abound in our tax system today. We have negative tax rates for debt-financed property where there's 50% expensing and accelerated depreciation. Every small business who borrows with 179 expensing has negative tax rates. Debt-financed solar equipment or alternative energy equipment, negative finance tax rates. The biggest investment, one of the biggest in our country, home ownership, big negative tax rates. Now, I'm not here to defend negative tax rates. I'm here to say they exist. And we ought to acknowledge them and ask, 0 is just a number. You got to ask, why do we care? The government knows we have negative tax rates. Maybe we're trying to incent certain investments. We certainly are in the alternative energy area. Maybe we need to provide incentives to machinery and equipment to offset the big negative tax rates in to owner-occupied housing. And I'll touch in a minute, another big negative tax rate would be foreign investors who could deduct interest investing in the U.S. would have a, quote, negative tax rate relative to U.S. investors. I'll hold that for a minute. But the point being, think through why we have negative tax rates and what the net policy is underlying them. So to pay for expensing, that's another reason people suggest we ought to allow a deduction for interest. Most models of economists show expensing creates a lot of growth. The interesting fact there is the business community is not interested in that trade at all for 2 reasons. One, book accounting. You're trading a permanent item, which is interest, for a timing item, which is expensing. And I will wrap up. Secondly, at today's incredibly low interest rates, the time value of money, which is all it is for expensing versus accelerated depreciation, means nothing. You'd also need a lot of complicated rules for financial services. enough about that. One point on the international competitiveness that I want to develop. If we deny interest, no other country in the world denies deductions for interest. If we were to do that, U.S.-based companies and U.S.-based investors in bidding for any debt-financed project would be at a disadvantage relative to foreign firms who could deduct interest in their home countries against their home tax base. So imagine either real estate in the U.S., which is highly levered, or a U.S. company, and a German company is going to bid for it. It can borrow money in Germany, deduct it in Germany, by the U.S. company. The U.S. company, who has only its tax bases in the U.S., cannot borrow money and deduct interest. There'll be an a powerful incentive for U.S. firms to merge with foreign firms, or have foreign firms take over U.S. firms, borrow in their home country, and refinance the non-deductible debt. I'm going to leave off. I'm out of time on the sectoral impacts. You have to deal with the leasing industry, the real estate industry. Losses, the only thing I'll say about losses is you would have large exporters like GE, CAT, Boeing, with large structural losses. They aren't going to be refunded. We know safe harbor leasing didn't work. Carry forwards with interest isn't the solution, as Roseanne suggests. What you'd have would be tax-motivated mergers. You'd have companies with these losses buying companies with tax base. And do we really want that? All right, over my time.
Thank you very much, John. And I think we could start with response from Alan.
Yeah, let me just respond quickly, because I want to leave people some time to ask questions. Just a couple of things. In response to Roseanne's comments, it's useful to, when thinking about a tax evasion, it's useful to think about the close relationship between this tax and the VAT. The evasion problems under this tax would be similar to the evasion problems under a VAT. Carousel fraud, other kinds of things like that, fictitious taxpayers, they exist under VATs. They would exist here, and it is an enforcement issue, and it's not something you can get around. I would just leave it at that. On John's comments, again, I'll only try to touch on a couple. There were many useful comments. I won't say anything about the WTO. I think I've said all I have the capacity to say. But as to why not adopt a subtraction method VAT and use part of the revenue to reduce or repeal payroll taxes as a way of dealing with WTO compliance, fine. A couple of things on that. First of all, the payroll tax rate is 15.3%, leaving aside the ACA, the surcharges for the ACA. And that's below the rate that we currently have on the corporate tax, and presumably below the rate even under the Brady proposal. So you'd have to come up with a way of further crediting, finding payroll taxes to reduce. Now you could certainly do it. I mean, you could recharacterize the income tax as a payroll tax plus a tax on non-wage and salary income, and then you could drop that too. There certainly could be done. I guess all I would say about that is that it's worth keeping in mind that the main reason for doing this is to be WTO compliant, and I guess at some point you might want to ask, is it worth it? I don't know. And there are issues having to do with, again, not insurmountable issues having to do with the trust fund. You mentioned the Social Security and Medicare trust funds. This issue came up when there was a payroll tax cut during the Obama administration. You have to be careful to do it in such a way that you're not affecting accumulations in the trust fund. And you can do it. People who care about the Social Security system get upset when you start talking about reducing payroll taxes, and even though it's just it's just an issue of form and not substance. On the final point about denial of interest deductions, you see it as a disadvantage. I actually see it as this is one of the aspects of the system that would lead foreign countries to be more likely to adopt the system if the U.S. did. If the U.S. adopts a system like this and says we're making the tax system neutral, but it's still possible if you're a multinational to borrow in some other country and then use the money to buy assets in the United States, well, that's going to erode the tax bases in other countries. And I think that's one of the things that's going to encourage other countries to adopt a proposal like this.
So let me just respond to that one point. I agree with that, looking through the lens of the tax collector.
Yeah.
But if you look at through the lens of industrial strategy, if it would give German companies a competitive advantage in acquiring assets around the world, it might be something that they would be willing to quote, subsidize.
But why a German company as opposed to a U.S. multinational with a German subsidiary?
Because they don't have the tax base. You have to start with where are companies, do they have tax base to deduct interest? And generally, all foreign companies have tax base in their home countries.
On the one final point on the literature, my reading of the literature on U.S. Borrowing decisions and taxation is that there are two things that are true. What you said is right, based on the literature, that U.S. companies appear not to take as much advantage of the interest deduction as they should. And you're right in citing Graham's paper on that. On the other hand, I think the evidence is pretty clear that U.S. companies do respond to marginal tax rates. Both in cross-section data and in panel data, time series data, variations in the effective ability to deduct interest and the rate at which interest can be deducted does influence corporate borrowing. Now, that doesn't say that corporations borrow enough. There has been a lot written about agency issues and other reasons why there's perhaps a lack of attempt to fully maximize shareholder value by borrowing and taking advantage of interest deductions. But I would disagree that we lack evidence that companies do respond to interest deduction. So I think there's a reason to care about the different tax treatment of debt and equity. It may not be as important an issue as it's sometimes made to be in the literature, but I certainly think it matters.
So on that, there was one paper I didn't cite. I agree with you, of course. Allowing deductions for interest results in more leverage than you would otherwise have. And I think that's undeniable. My only point is it isn't a problem. It hasn't proven to be a structural problem for companies or the economy. But a paper written by some economists at Wharton and Carnegie Mellon recently concluded that if we eliminated the deduction for interest, we would have less leverage, but more defaults and greater credit spreads, because companies would have a higher cost of capital, and companies on the margin, more companies would tip over the edge.
Okay, questions from the floor?
Alan Viard, American Enterprise Institute. So the economic properties of destination-based cash flow taxes are really attractive, and you get some of those advantages with an origin-based cash flow tax, but not all of them. The biggest drawback of the destination basis is that you are giving up various tax revenues that you could collect from foreigners. And Alan and Roseanne, both of you mentioned that. And if it's natural resources, for example, you could do that through a separate tax. That's right. There is the question of the existing assets. So if we repeal the corporate income tax today, we'd be giving up some revenue that we would collect from foreigners who are investing in the United States. By replacing it with the destination-based cash flow tax, we're not going to be collecting anything from those foreigners. On the other hand, if we went to an origin-based cash flow tax, we could collect actually a very large amount of revenue potentially from foreign holders of U.S. assets as they consume from those, more than we're giving up if we wanted to go that far. How should these cross-border transitional wealth effects influence our thinking about destination versus origin basis?
I think they matter, and I don't think that we should ignore them and simply say or minimize them simply by saying, well, that's just a transition problem, because the amounts of money can be quite significant. For some of the transition losses that you get here, there would be the possibility of recoupment. For example, I mentioned the tax on foreign source earnings, previous foreign source earnings. You could go after that. You could, the rate at which you go after it is, obviously not going to have much of a behavioral an effect. The other things that you may not be able to do, to the extent that foreign shareholders have own assets in the U.S. and all of a sudden you've given them a windfall because there's no longer any territorial tax. I agree with you. That is an issue. I mean, it really relates to the fact that when you have an origin-based or a territorial tax system, which the U.S. has in addition to taxation of foreign source income, you're imposing a tax on earnings in the U.S. And if you all of a sudden give that tax up, there are going to be benefits to foreign shareholders. I think it would be worth further consideration how one could deal with this in transition, and this is something we probably haven't given enough thought to in our discussion, because we were focused primarily on trying to make a workable tax system in the long run. But I do agree that that's certainly an issue that if one were getting very serious about adoption of this, one would want to think about more.
Yep. Eric?
Eric Toder, Tax Policy Center. I wanted to follow up on one of Roseanne's points, Alan, and this has to do with how you would change the taxation of individual income, particularly individual investment income, in would or would not change that. And I'm thinking particularly with interest income, you're denying interest deductions. Would you then exempt interest income of individuals who buy corporate shares or government bonds and so forth? And then if you do that, what do you do about mortgage interest and so forth?
One of the issues that we struggled with in our committee was how much to talk about freestanding corporate tax reform and how much to talk about integrated reform of the entire tax system. And of course, this is the same struggle that's been going on in U.S. policy debates in the last few years. In the end, we decided to focus primarily on business tax reform, while at the same time recognizing that there might be more of an imperative for reform at the individual level if you did something like this. So as a group, we don't really have much to say about it. As an individual, I would say, yes, you would certainly want to think about individual reform as well. I think the GIT proposal that Roseanne talked about earlier would have had a 15% tax rate on all individual capital income, but without any other reforms.
That was a weakness.
In other writing, I've proposed moving toward accrual equivalent capital gains taxation. I still think it's a good idea, and particularly if the rates were not particularly high, having some sort of flat rate individual capital income tax, including some reform version of the capital gains tax, would be an improvement over the current system. I think one while thinking that those reforms are needed, I think one could still think about them as a separate part of the comprehensive legislation that one is adopting.
Yeah, so there's a quick question from Roseanne, and then I'll come back there.
Sorry, I just have a quick question for John while he's up here. Let's say that the businesses said, you know what, you're right, we should move to this consumption, this form of consumption taxation. We're not happy about giving up interest deductions. You all don't understand that we don't really care about, expensing's not our thing, but we're willing to go along with this. On transition, do you see businesses accepting a transition to this? So what we did on the panel is we said, well, next year you're going to get 80% of your depreciation deductions and then take 80% of your existing interest deductions, then 60, 40, 20. Would you see, how big of an additional step would that be?
Well, first, let me be clear. I'm not speaking for business. I don't have that.
Yeah.
And there are some businesses, very few, but some who would take the trade-off of expensing versus interest, but very few. And I don't think it's a transitional issue because it's really a combination of book income and people are pretty much convinced that they're going to keep bonus depreciation forever, or there isn't that big a difference between 5-year and 3-year write-off and expensing, and particularly at low interest rates. It just isn't that big a deal.
I've got 2 questions here. First at the back.
I'm going to channel Kevin Brady and Paul Ryan, who used the word leapfrog. Mr. Ryan used it on January 24th, June 24th, when he introduced the blueprint. And Mr. Brady used it the other day on C-SPAN. And when he said leapfrog, what he meant